The house always wins. That is the founding myth of the casino business. The idea that owning one is a license to print money, that the mathematical edge built into every game guarantees a river of profit flowing permanently toward the operator. It is the most seductive pitch in American commercial real estate. It is also demonstrably false for the majority of people who believe it enough to invest. In 2023 alone, 3 regional casino operators filed for Chapter 11 bankruptcy protection. The largest, Tropicana Las Vegas, closed its doors permanently after 67 years of operation. The building was demolished. The land was sold to the Oakland Athletics baseball franchise for a stadium. A casino that had processed billions of dollars in wagers across 7 decades ended as a parking lot. Here is what owning a casino actually costs. The number that stops most serious investors before they reach the business plan is the licensing cost. A commercial casino license in a mature U.S. gaming jurisdiction, Nevada, New Jersey, Mississippi, or Pennsylvania, costs between $500,000 and $25 million in application fees alone before a single dollar of construction begins. Pennsylvania's Category 1 license, which authorizes slot machines and table games, carried a one-time fee of $50 million when the state first issued them in 2006. Those licenses have since traded on the secondary market for up to $85 million. The license is not the building, it is not the equipment, it is permission to apply for the right to operate. Regulatory compliance costs run separately and continuously. Before opening, a new operator in New Jersey must submit to background investigations that typically cost $2 million to $5 million in legal and consulting fees, paid by the applicant, not the state. Nevada's Gaming Control Board investigation process averages 18 months and $3 million in preparation costs for a major operator. The physical facility adds another layer. A competitive regional casino in 2024 requires a minimum of 50,000 square feet of gaming floor to attract the customer volume necessary to service the operating cost structure, at $400 to $600 per square foot for casino-grade construction, reinforced floors for slot machine weight, redundant power systems, surveillance infrastructure embedded in the ceiling grid. A 50,000 square foot facility costs $20 million to $30 million before furnishing, equipment, or technology. Slot machines, the primary revenue driver in most U.S. casinos, cost $15,000 to $25,000 per unit new. A 500-machine floor, small by industry standards, represents $7.5 million to $12.5 million in equipment alone. Table game layouts, shufflers, chips, and cards add another $2 million to $4 million for a modest 30-table room. Technology infrastructure, the casino management system that tracks every transaction, every player card swipe, every jackpot, and every regulatory reporting requirement, costs $3 million to $8 million to implement for a mid-size property. This system is not optional. Regulatory compliance requires it. Pre-opening marketing, staffing ramp-up, and working capital reserve, $5 million to $10 million for a regional property. Total entry cost for a competitive regional casino before the first patron walks through the door, $80 million to $175 million. The license, the building, the machines, the technology, the compliance infrastructure, and the operating reserve. $80 million is the floor, and that floor assumes a jurisdiction where licenses are available, construction costs are moderate, and the regulatory process does not trigger extended hearings or legal challenges from competitors already operating in the market. A casino's operating cost structure is unlike most retail or hospitality businesses because it carries regulatory compliance as a fixed operating expense rather than a one-time setup cost. Every department generates compliance cost continuously. Labor is the largest single line item. A regional casino employing 800 to 1,200 workers, the range for a mid-size property, carries an annual labor cost of $45 million to $70 million, including wages, benefits, and the mandatory training and certification requirements for gaming employees in most jurisdictions. Dealers must be licensed individually in most states. Surveillance staff require specific certifications. Key employee licenses for pit bosses and cage managers cost $1,500 to $5,000 per person annually in renewal fees paid by the operator. Gaming taxes are the second largest cost, and in most jurisdictions, they are assessed on gross gaming revenue before any operating expenses are deducted. Pennsylvania taxes slots at 54% of gross gaming revenue. Maryland taxes at 67% on slots and 20% on table games. Ohio at 33%. Nevada, the most operator-friendly state in the country, taxes gross gaming revenue at a sliding scale from 3.5% to 8%. The average effective gaming tax rate across U.S. commercial casinos is approximately 22% of gross gaming revenue. This is a tax on top-line revenue, not profit. It applies whether the operator turns a profit or not. Utilities for a 24-hour operation running 365 days per year. The power load of slot machines, the HVAC demands of a smoke-filtered gaming floor, the lighting requirements of a facility designed to eliminate perception of time, average $4 million to $7 million per year for a mid-size property. Surveillance and security systems require ongoing maintenance contracts averaging $800,000 to $1.5 million annually, plus staffing. A typical regional casino operates 2,000 to 4,000 camera positions. The recordings must be retained for a minimum of 7 to 30 days depending on jurisdiction, stored on systems that cannot be tampered with by casino employees. The storage and system integrity auditing costs run $400,000 to $900,000 per year, separately from the hardware maintenance. Regulatory compliance reporting, the monthly, quarterly, and annual filings required by state gaming commissions, consumes $500,000 to $1.5 million per year in accounting, legal, and dedicated compliance staff. Insurance for a gaming property, $3 million to $6 million annually, covering general liability, property, crime, and the specialized coverage required for jackpot liabilities. Maintenance and capital reinvestment. Slot machines require continuous maintenance and periodic replacement. The industry standard is a 7-year depreciation cycle on slot equipment, meaning a 500-machine floor requires replacing approximately 70 machines per year at $15,000 to $25,000 each, $1.5 million to $1.75 million in annual equipment cycling, just to maintain competitive floor product. Total annual operating cost before a single dollar of revenue for a mid-size regional casino with 800 employees and a 500-machine floor, $72 million to $105 million. Casino revenue is measured in a metric called win per unit per day, the average amount the house retains from each slot machine or table game position every 24 hours. In Nevada, the statewide average win per slot machine per day in 2023 was $187, according to the Nevada Gaming Control Board. In regional markets with less foot traffic and more competition, the figure is lower. Mississippi riverboat casinos average $112 to $140 per machine per day. Indiana, $145 to $165. Using the Nevada figure of $187 on a 500-machine floor, operating 365 days per year, gross slot revenue of $34.1 million annually, a 30-table room at the average regional casino table drop and hold, generates approximately $8 million to $12 million per year in gross gaming revenue. Total gross gaming revenue for a mid-size regional property, $42 million to $46 million annually. Apply the average 22% effective gaming tax, $9.2 million to $10.1 million rave before any operating cost. Post-tax gross gaming revenue, $32 million to $36 million, against annual operating costs of $72 million to $105 million. This produces an operating loss of $36 million to $73 million on gaming revenue alone, before accounting for hotel, food, beverage, and entertainment revenue. A complete regional casino resort with hotel, multiple food and beverage outlets, and entertainment generates total revenue of $90 million to $150 million annually. Subtract operating costs and gaming tax. Net operating margin for a mid-size regional casino property, 4% on $120 million in total revenue. That is $4.8 million to $13.2 million in operating income on an $80 million to $175 million entry investment. The payback period on the capital investment at the optimistic margin is 6 to 36 years. At the lower end of the margin range, the investment never pays back under current operating conditions. That margin assumes a stable external environment. The casino industry does not operate in a stable external environment. There is one variable that has destroyed more casino businesses than any management failure, any competitive pressure, or any regulatory change, and it is entirely outside the operator's control. The casino industry is structurally tethered to consumer discretionary spending, which is among the most volatile categories in the economy. When the consumer pulls back, gambling is among the first expenditures cut. When credit tightens, the customer who finances weekend casino trips stops making them. The 2008 financial crisis produced the most severe contraction in U.S. commercial gaming history. Between 2007 and 2010, commercial casino gaming revenue fell from $34.1 billion nationally to $30.7 billion, a 10% decline across the industry. In Atlantic City, the decline was catastrophic. The market peaked at $5.2 billion in gaming revenue in 2006. By 2013, it had fallen to $2.8 billion, a 46% collapse in 7 years. 5 of the 12 casinos operating in Atlantic City in 2006 had closed permanently by 2016. The mechanism is not just reduced traffic, it is reduced credit availability. Casino customers at the mid to premium tier routinely access gaming credit, lines of credit extended by the casino's cage against verified assets. In 2008 and 2009, casino credit utilization collapsed simultaneously with the customer's ability to repay existing markers. Atlantic Club Casino reported $42 million in uncollectible gaming markers in its 2013 bankruptcy filing, debt that appeared on the revenue ledger but would never be collected. The operating leverage of a casino amplifies this volatility in a specific and destructive way, because 70% to 80% of the cost structure is fixed: labor, regulatory compliance, debt service, utilities. A 20% revenue decline does not produce a 20% profit decline. It produces an 80% to 100% profit wipeout, followed by operating losses. The business that was marginally profitable at full revenue becomes deeply cash flow negative on a modest decline, and the fixed costs do not negotiate. The company that understood this dynamic better than anyone, that had survived multiple recessions and multiple competitive disruptions, that employed 25,000 people and operated casinos on 3 continents, that company collapsed anyway, because understanding the risk and surviving it are different things when the scale of the exposure exceeds the capital available to absorb it. Caesars Entertainment, formerly Harrah's Entertainment, was the largest casino company in the world by number of properties when it was taken private in a leveraged buyout by Apollo Global Management and TPG Capital in 2008. The purchase price was $30.7 billion. The debt load taken on to finance the acquisition, $24.7 billion. The timing was precise in its catastrophic quality. The LBO closed in January 2008. The financial crisis began accelerating in September 2008. Caesars entered the worst consumer spending contraction in a generation, carrying $24.7 billion in debt, at a moment when its revenue base was collapsing. Between 2008 and 2014, Caesars reported cumulative net losses exceeding $10 billion. The company attempted 17 separate debt restructuring transactions. It sold assets, refinanced tranches, and restructured operating subsidiaries in increasingly complex attempts to avoid the inevitable. In January 2015, Caesars Entertainment Operating Company, the principal subsidiary holding most of the gaming properties, filed for Chapter 11 bankruptcy protection with $18.4 billion in liabilities. The bankruptcy proceedings lasted 3 years. Creditors recovered approximately 66 cents on the dollar. Bondholders who had purchased Caesars debt at par received significantly less. The restructured company emerged from bankruptcy in 2017 under new management and significantly reduced debt, but with the same underlying operational margin structure that had made the original debt load unserviceable. This was not a management failure. Caesars employed some of the most experienced operators in the industry. It was a structural failure. A business with a 4% to 11% operating margin cannot service a debt load sized for a 20% margin business. The math was incompatible from the date the deal closed. The 2008 crisis did not create the problem. It revealed it. Casino credit, the marker system, is the financial instrument that makes premium gaming possible and profitable in theory. In practice, it is one of the most misunderstood cost generators in the industry. A marker is a line of credit extended by the casino cage to a verified high-value player against documented assets. The player draws markers during play and is expected to repay within 30 days. No interest is charged. The casino earns the revenue through the player's losses, not through financing charges. The system appears profitable in the transaction. A player draws a $50,000 marker, loses $30,000, and repays $50,000. The casino nets $30,000 in gaming win, plus the full marker repayment. On paper, this is a $30,000 revenue event. The hidden cost emerges in the collection process. Casino markers are legally enforceable as instruments of debt in Nevada and several other jurisdictions. But collection requires legal action in the player's home state, which may have different laws governing gaming debt enforceability. Collection attorneys charge 25% to 40% of recovered amounts. If the player is in a jurisdiction where gaming debts are not enforceable, and several are, the marker is uncollectible entirely. The industry average uncollectible marker rate is 3% to 7% of total markers issued. For a premium property, issuing $100 million per year in gaming credit, uncollectible debt runs $3 million to $7 million annually. This cost does not appear in the operating budget as an expense. It appears as revenue that never converts to cash, making the actual cash margin of the premium gaming segment 15% to 25% lower than the gross revenue figures suggest. There is another cost growing faster than any other line item in the casino industry right now, one that did not exist as a material budget line in 2015 and now represents the fastest growing compliance expense in the sector. Anti-money laundering compliance, AML, has become the defining regulatory cost escalation in the casino industry over the past decade. Casinos are designated as financial institutions under the Bank Secrecy Act, which requires them to file currency transaction reports for all cash transactions above $10,000 and suspicious activity reports for any transaction that exhibits money laundering indicators, regardless of amount. The compliance infrastructure required to meet these obligations has grown dramatically. In 2014, the average regional casino spent $800,000 to $1.5 million annually on AML compliance staff, training, and systems. By 2024, that figure is $3 million to $6 million for the same size property, a 300% increase over 10 years. The penalty structure for AML failures explains the escalation. In 2017, the U.S. Department of Justice fined Las Vegas Sands Corporation $47.4 million for AML violations related to insufficient monitoring of large cash transactions. In 2021, Nevada's Gaming Control Board fined Station Casinos $1.5 million for BSA compliance failures, a relatively modest penalty by federal standards, but significant enough to represent a full year of operating profit for a regional property. The most significant AML enforcement action in gaming history was the $613 million penalty against Commonwealth Bank of Australia in 2018 for systemic failures in its gaming transaction monitoring, a case that sent compliance officers at every major gaming company in every jurisdiction into emergency program reviews. A single AML enforcement action at the federal level can produce penalties exceeding the operator's annual net income. The compliance program is not a cost center, it is existential insurance. Scale in the casino business creates specific advantages and specific new vulnerabilities that do not exist at smaller operating sizes. What improves at scale? Purchasing power over slot machine manufacturers, who offer volume discounts of 15% to 25% on large orders. Ability to self-insure jackpot liability above a threshold. Major operators carry jackpot insurance only for individual payouts above $5 million, self-funding everything below. Marketing efficiency through loyalty program data. A player database of 3 million members has measurably lower cost per visit than one with 300,000 members. What becomes harder at scale? Regulatory exposure multiplies with property count. Each jurisdiction has separate compliance requirements, separate tax structures, and separate licensing renewal cycles. A 10-property operator faces 10 separate regulatory calendars, 10 sets of annual license renewal fees, and 10 independent compliance audit cycles. Labor relations become more complex. Larger workforces in more jurisdictions increase the probability of collective bargaining disputes, which in 2023 produced a 47-day strike by 10,000 workers across Las Vegas Strip properties that cost operators an estimated $1.5 billion in diverted revenue. At a certain scale, roughly $500 million in annual revenue, it is a financial institution with a gaming floor attached. The regulatory relationship with multiple state gaming commissions, the federal AML obligations, the public company reporting requirements if listed, and the debt capital markets access required to fund growth transform the management challenge completely. The skills that build a successful regional casino are not the skills that manage a $5 billion enterprise operating across 10 jurisdictions. The optimistic scenario: a regional casino opens in a market with limited competition, total investment $110 million, annual gross gaming revenue reaches $52 million by year 3. Hotel, food and beverage add $35 million, total revenue $87 million. Gaming tax at 22%, $11.4 million. Operating costs, $68 million. Net operating income, $7.6 million. Operating margin, 8.7%. On $110 million invested, that is a 6.9% annual cash-on-cash return. Debt service, on $70 million in construction financing, at 7.5%, over 20 years. Net cash flow after debt service, $900,000 per year. The operator is profitable by $900,000 on a $110 million investment. The realistic scenario: the same property in year 4 receives an AML compliance inquiry from FinCEN following a pattern in transaction reporting. Legal and compliance response costs, $4 million over 18 months. A competitor opens 40 miles away in year 5, reducing slot win per unit per day from $165 to $138. A 116% revenue decline, producing a $7.2 million gross revenue reduction. A jackpot, exceeding the self-insurance threshold, triggers a $3.5 million payout, not fully covered by the jackpot insurance deductible. Total impact, $14.7 million against a $900,000 cash flow baseline. The property moves from marginally profitable to $13.8 million cash flow negative in a single operating year. The difference between those two scenarios is a regulatory inquiry, one new competitor, and one large jackpot. None of these are exotic disasters. All three happen to someone in this industry every quarter. The American Gaming Association estimates that 23% of new casino operations that open without an existing operator affiliation fail within 5 years. The primary cause is not gaming floor performance. It is capitalization, specifically insufficient reserves to absorb the volatility documented throughout this video. The operators who survive through multiple cycles share 5 specific operational characteristics that are not motivational habits. They are financial structures. They carry a minimum of 18 months of fixed operating costs in liquid reserves or committed credit facilities before opening, not 6 months, not 12, 18. The regional operators who survived the 2008 contraction held this level of liquidity. The ones that did not survive. They negotiate gaming tax structures with jurisdictions before committing capital, and they do not open in markets where the effective gaming tax rate exceeds 35% of gross gaming revenue. Pennsylvania's 54% slots tax rate is survivable only at very high revenue volumes. The break-even revenue threshold at that rate is approximately 40% higher than in Nevada. They treat their slot floor as a depreciating asset and fund replacement capital annually into a separate reserve account, not from operating cash flow in the replacement year, but as a continuous annual contribution. The operators who defer equipment replacement to preserve short-term margin discover in year 8 or 9 that their floor is uncompetitive and their volume has declined to a level that cannot fund the catch-up investment. They employ AML compliance officers at a ratio of 1 per $8 million to $10 million in annual gaming revenue, above the minimum regulatory expectation, because a single FinCEN action costs more than 5 years of the overstaffing expense. They never use variable rate debt to finance fixed assets. Every casino operator that failed during the 2008 to 2012 period carried floating rate debt. When base rates rose and revenue fell simultaneously, the debt service consumed the remaining operating margin entirely. The casino, chandeliers, card tables, the permanent hum of machines paying out at mathematical precision, a business that never closes, that charges admission through probability, that has processed more transactions than most banks. That business carries a $80 million to $175 million entry cost, a 4% to 11% operating margin on a good year, an AML compliance budget growing at 300% per decade, and a volatility structure that can convert a profitable year into a $13.8 million loss through a regulatory inquiry, one competitor opening, and one large jackpot. Caesars, 25,000 employees, 3 continents, 67 years, filed for bankruptcy with $18.4 billion in liabilities because the margin structure of this business cannot carry debt sized for a different business. The house always wins is not a business model. It is a marketing slogan. The actual business model is thin margins, enormous fixed costs, continuous regulatory escalation, and the permanent possibility that the next quarter is the one that tests whether your reserve account is large enough. Subscribe if this kind of numbers-first forensic breakdown is what you want to see more of, because next week, the same analysis runs on a different industry that looks even more profitable from the outside.